Friends, welcome once again. So, audit is a practice well regulated, and it has its own statutory framework. So, when you hear the word statutory, it means backed by law or by legislation. So, there's a statutory framework within which audits must be conducted. I wanted to look into that, then we will proceed to the next phase as well. Okay. All right. So, we're looking at the statutory framework for audit, or for auditing as a practice. This will be faster. Okay. So we want to understand the statutory framework within which we conduct our audits. What are the limits for company audits? Once again, I'll entreat you to read the book. Okay, this is a summary. This is a summary because if you take the chapter on the statutory audits, it appears to be, it has some good information there, and it's more, it's a lot in the book than on the slides. It's a give and take. Sometimes I speak more on the slides, so you don't even want to go and look into the books. Sometimes I abridge it, and then you have to go and read more on that side. Okay, so it's a give and take. But I'm doing more of the talking so that you can skip the book if you don't want to consult the book. Okay. Now, who can be and who cannot be an auditor, or who can become a registered auditor? The requirement of the recognized supervisory body, the RSBs, the ACCA, ICAS, ICAEW, which one again? CA Ireland, CAI, okay. Process of appointing and removal of auditors, I'll briefly touch on that, and resignation, duties and rights of auditors and their powers. We may have heard of that over and over, okay. And then understanding the basis of audit remuneration and appreciating the conflict. I'll leave that one for you to research into it, okay? But I'll introduce something briefly there, okay? Then purpose and procedures of an AGM. I'll leave you to read more on that one. So usually statutory audit, who is it for? Okay, who is it for now? Small companies, these guys normally will be exempted. Small groups will be exempted. Charities, dormant companies, small charities, they will be exempted. But let us look at this. So we will normally define these small companies as private limited companies, okay? They are not part of a larger group. They are not in the banking sector, nor in the insurance company. Now, their turnover must be 10.2 million or less. Threshold has changed, actually. It used to be 5 million thereabout, and balance sheet was 3.26 million thereabout, but it has changed, okay? Where their turnover must be 10.2 or less, the balance sheet totals 5.1 million or less, and they employ fewer than what? 50 persons. Now, here we have been told that small companies who fulfill 2 of these criteria do not need what is known as a statutory audit. Okay, if they meet any 2 of these, they don't meet the threshold to be audited. Now, not to be audited, let me clarify, to undergo a statutory audit, okay? Because I know firms whose revenue base is far less than this. Their balance sheet totals far less than this. They employ fewer than 50 people, but they still audit. They still go through audits. Whereas for other compliance purposes, okay, to file to the company house to show that their books are okay, it happens. But that's it. Again, small groups, the same limit applies to small companies, okay, except that reference can be made to net or gross amount. So here we are saying that, listen, for the small groups, if the equivalent figures turnover 10.2, the same as above, right? But the gross being 12.2 million. Balance sheet total, the same as above, 5.1. But the gross figures is 6.1. You know why we are saying gross and net? Because the balance sheet will show the net assets after they've taken care of the the current liabilities, okay? Once they get rid of the current liabilities from the current assets, they get the net current assets, and then they add it to the non-current assets and get the net assets. That is what we mean, 5.1. But the gross figure, where we do not factor in the net figure of the net assets, we just leave them to stand on their own then. So the aggregate number of employees, again, not to be more than 50, then these groups cannot be eligible. This cannot. Okay, but we are saying that groups cannot be eligible for exemptions. Okay, group companies under IFRS 10 business combinations, they cannot be eligible for exemption if any member of the group falls within one of the above criteria cited, because the subsidiary has a turnover of 9.3, employs 40 people. It's part of the group. Consolidated, when you add all of them up, you realize that their figures quite far exceeds what has been reported by the threshold. Okay, who else is exempted? Small charities. Okay, again here the thresholds have changed, but like I said, we are growing, so they always keep giving us. So again, small charities that are companies, gross annual income of 1 million or more, and charities with a balance sheet of 3.26 or more, and an income of 240. Okay, so organizations not needing an audit. Dormant companies, you can see these companies is not been functioning over the period. Organizations which are not public, they are not banking, they are not insurance companies. And again, we're looking at organizations not authorized, which are not authorized people, are appointed representatives under the Financial Services and Markets Act are all exempted. Let's move on. Who can be an auditor? Before we come to who can be an auditor, let's look at the auditor's role, okay? The auditor will need to obtain sufficient, appropriate evidence, reliable evidence to support the audited financial statements. And they must also look out for whether these comply with some applicable laws and regulations which underpin the very foundations of the financial statements. Now, auditors must also have regard to these laws, these regulations, because why? They provide a framework within which the business operates. They govern the entire surrounding, the operating business environment. So they must also give regard to these laws and regulations. Now, ISA 250 requires us as auditors to always apply the highest level of professional skepticism. Okay, and in these instances, it is required that once we are reviewing these with our doubt, okay, skepticism is a form of a doubt, professional doubt, okay? We must recognize that the audit may reveal some instances of non-compliance, and we need to flag them out, okay? And see the extent to which these non-compliance items can affect the financial statement we are auditing. And look at it, whether the non-compliance has led to some material pervasive effects on the financials, okay? Who can be an auditor? Someone who is independent from the client, okay? Now, someone who is also recognized by his professional body, the RSB, recognized supervisory body. You may ask, who is such a person, okay? So it's not anybody at all. You see some people working in audit firms, with the big four audit firms, with the other smaller, medium-sized audit firms, and they say, I'm an auditor. They are not auditors. That's why you normally see audit trainees. They use the word audit trainees. They use the word audit associates. They are just an associate, an attachment to the audit firm, okay? But until such a time when they have qualified their professional exams and recognized by their RSB, then we can say you are an auditor, okay? But again, even if you are qualified and you are not practicing, you cannot be called an auditor, okay? So we take note. Who cannot be an auditor? Any officer or employee of the company cannot be an auditor. This is different from internal audit. Internal auditors are employees of the company. That's different, okay? Any partners, okay, or employees of such persons. So let's say an officer of the company, the CEO's wife, is a chartered accountant, cannot be an auditor of that company. Conflict of interest could come in, okay? So if I am a chartered accountant and then I'm qualified to audit, let's say, ABC company, but my wife or my daughter or my friend, somebody who is a close ally, somebody who has some relationship with me is there, it's quite difficult for me to become an auditor of that company, especially when those persons hold positions of trust, okay? So anyone who's got a connection with the company, the associates They cannot be, okay? Now, also, there are some people who are not eligible to act as auditors of a particular company. Why? Because of some other reasons, okay? Because they're ineligible to act as auditors for some other reasons. Now, if I'm not eligible to act as an auditor of, let's say, HSBC company, let me use HSBC. But let's say HSBC has some subsidiaries and associates, some joint ventureship. Equally, just as I cannot audit them, I'm not in good standing to audit them. I cannot audit their partners, their subsidiaries, okay, or anyone who is associated to them. IAS 28 business, IAS 28 associates of a company, we cannot, okay, consider joint ventures. We cannot be auditors of those firms if we are not eligible to act as auditors of the parent company, okay. There's a regulatory framework which governs our audit practice, okay. All members carrying out audit must be approved by their responsible framework, responsible professional bodies, the RSB supervisory bodies. So like I said, in the UK predominantly we have these four: ICAEW governing England and Wales, ICAS governing Scotland, CAI Northern Ireland, and then ACCA governing all of them, cuts across all of them. All right. CIMA doesn't come in here because CIMA they do nothing or less of audit. They are more into management accounting, so they don't really come in when it comes to audit. The Financial Reporting Council is a regulator of corporate reporting and governance across, okay? And this is what the RSBs do, the SEC and ICAS and the rest. What do? They ensure ethical rules of to ensure integrity and independence of the auditors. You know, we write their exams, ICAS exams, ACC exams. They also look at technical standards. They always update these technical standards, financial reporting standards. And they also advise the firms on PIIs requirements, professional indemnity insurance. Of course, they regulate it, okay? They regulate it. They also monitor firms to ensure these firms follow the rules and procedures of work, okay? Any complaints in the line of work, you can go to your RSB and they will actually support you. There's always also rules for admitting and excluding members. If you misbehave, they clear your name from the register. That's why you should always be in good standing. So let's take a good one. The rules, okay, the regulation of the professional bodies. We'll come to this again when we're looking at the auditing and accounting standards. So we have the Financial Reporting Council. Right underneath them, we have these other guys who report to them, the Audit and Risk Committee and People Committee, and they are normally seen as the tribunal panel. When you hear the word tribunal, you understand, okay? Now, under them, we have the next layer of auditors or of committees, where we have the Supervision Committee, the Conduct Committee, Regulatory Standards and Codes Committee, and here we call them the Enforcement Committee panel, okay? And then all together, we have the non-executive advisory panel, and these are experts who are called upon by these various committees to assist them, all of them. Okay, and these are all technical guys. They understand what they do. They know what they do. All right. Auditors are appointed by shareholders. Similarly, they are removed by shareholders at the AGM. Directors could, of course, refer an auditor to fill a vacant position. An auditor, just as he or she is appointed by the shareholders or removed by the shareholders, would also resign at any time or seek for re-election by putting it in a written format and presenting it at the annual general meeting for the shareholders to consider. All right. There's more. I would love you to look at them when you take the book, okay? Now, what are our responsibilities as auditors? We are required to audit the financial statements, review compliance with the UK Corporate Governance Code 2018. For now, we'll say 2018. It could change if we update it over time. Again, you also have to review other information in the account. 720 ISA 720, other information in documents containing audited financial statements. Today, you see CSR reports, you see strategic strategic reports, you see CEO's comments, you see sustainability reports, which are included as part of the audited financial statements. So today you see integrated financial statements, integrated annual accounts, or so far as these would form part of our audited financial statements, auditors, we need to review them. We need to review them, okay? Now, annual report responsibilities. Remember, it is the role, it is the responsibility of the directors to prepare these financial statements. We audit it, okay? So as well as the audit of the numbers, we have responsibilities over the report as a whole, okay? Any narratives that will accompany our statements, we must make sure they are not misleading. Listed companies, we require them. For them, they have more stringent measures. Those PLCs, in addition to the figures, we need to ensure have they comply with the corporate governance code, okay? What are the board decisions, responsibilities? What is the composition of the NEDs, okay, the committees, the various committees, any controls instituted by the directors, robust enough, efficient. Consider the truth and fairness of reports on the auditor's remuneration. This one, we audit it. We have the policy, we have the remuneration package, we audit, we disclose it, okay? Like I said, any strategic report, any assumptions, any CEO comments that would underpin the financial statement, that will form part of the audited financial statement, we need to review them. We are always engaged under our terms of engagement, in the letter of engagement. ISA 210 specifies terms of the engagement, but for listed companies, it could include additional reviews, like the code of the corporate governance code, okay, strategic reviews and all those things. Now, the directors, auditors, they all need to report on their respective responsibilities. Today, take a very good audited account, and you see that they clearly specify the roles, the responsibilities of directors and of managers, of management, or of auditors. So we clearly tell you that, listen, this is our responsibility as auditors, and this is what management is required to do. This is helping to bridge that expectation gap so that people will know the liability gap will be closed, so that people will know who is doing what and who is reporting to whom. Okay, standards gap could also be reduced if we do this well. Auditors can report by exception. That is only if something is not done, they can report on those exceptions. So for example, if the company has not complied with a specific portion of the UK Corporate Governance Code, the audit report could read as this. Let's say the listing rules of the London Stock Exchange requires us to report any instances when the company has not complied with certain of the disclosures, disclosure requirements set out in the rules. Then we continue. In connection with these, we report that, in our opinion, the company has not complied with the requirement of paragraph 42.2, section 3 of the Corporate Governance Code, okay, UK Corporate Governance Code. Okay, because you don't just leave it hanging, because then you specify the reason why you think they've not complied. Because the report on the director's remuneration does not report that the chairman has the exclusive use of a private jet leased by the company. State it clearly why you think they've not complied. Don't leave it hanging. Don't let people read their own meanings into it. Compliance and internal control, I mentioned that, listen, we must understand the entire system of internal controls, okay, including any internal audit function. It is our role, if we want to do a better job than ISA 315, we need to understand the entity, its operating environment, and also assess any risk of material misstatements which could occur. So directors, ideally, they need to ensure that the company has complied with the laws and regulations, and they must establish strong internal control systems to prevent non-compliance. Okay, so we need to review this. We need to understand this, okay? I'm going to end here, but I want us to look at one or two things in terms of remuneration of auditors, okay? So before we go to that section, look at these two case studies, very short ones, Mainbrace and Winfred Metal Reclamation. And then you should also attempt the examination question on page 51. so that you can better understand the regulatory framework and regimes governing the audit profession, okay? And of course, the self-testing questions. All right, so there was one item on the remuneration, okay? I said appreciate auditors' remuneration and conflict of interest. Now, if the auditor relies so much significantly on these clients, or let's say a good amount of the income comes from this client, it could impair their judgment, okay? So there is always a caveat which is provided, okay? Under Companies Act, I think section 492, we have been told that the remuneration of the auditors is fixed by those who appoint them. The shareholders will usually do this, okay? At the AGM, okay? So this is what is required. But at the end of the day, it is the management that will pay them. Okay, it's the management that will pay them. So there must always be some form of independence of the auditors, okay, appointed by the shareholders in general in the AGM, okay? But at the end of the day, they must ensure that whatever income they are getting from the client does not constitute a significant portion of the overall revenue, else there could be issues of conflict of interest. I know of a company, I will not mention the name. It is one of the big four, so you can conjecture. And they have a client, and this is in an African country. I will not mention, but it is within the Southern African region. And that client alone fetches these big four $10 million as audit fees, not at audit expenses. Audit expenses will come. And of course, this one is even public knowledge, because if you pick the account of that company, let me give you the name of the company. You go online, you can find it, Nedbank in South Africa. Go in, look at the account, and you will see the audit fees that they pay, just one client. That is a lot of money. Okay, it tells you that it's significant. I will not say much. All right. Okay, friends, I'll leave it here. Auditors, we have rights, we have responsibilities, okay? We have access to all the books of the company. We have the access to talk to anybody when we are doing our audits. Okay, if we need any information, we can go all out. We can establish that strong networking relationship, go find any information. That is what gives the auditor the confidence to approach any situation without fear or favor, because you have that right. You are being imbued with some legal backing to go do this work. All right. Okay, I'll leave it here. So once again, friends, take the book, okay? Take the book. There's a lot of things we've not cited. The power of the auditor, okay? Appropriate qualifications, professional bodies, disciplinary rules. Okay, read the book. Read the book. Chapter 3. Read the book. There's more to it than just the slides, okay? There's more to it, but the key parts are what I have provided to you. Okay, I'll see you in the next session, and bye for now.